concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
We're going to get the spoken word now on the stock market, as we do every month about this time, with our chief equity strategist, John Blank, who joins us via Skype from the West Coast. John, in the latest Fed meeting that just wrapped up here, Fed left rates unchanged once again. No surprise in that, but there are some out there who are saying that the Fed signaled a little concern with Brexit. How much do you think that weighed into their decision making?
It certainly weighed in heavily in the decision between June and July decision making. They almost certainly put off everything into July that they would have done in June based on Brexit.
So what about the odds now for a rate hike this summer versus a rate hike much later this year? Where do we stand?
Well, the market says that's a 5 or 10% chance of a July rate hike now. I don't think that's anywhere near right. I think it's a 40 to 50% chance of a hike in July. It's certainly not a done deal. It's all based on the payroll number that comes out here in about 3 weeks. But if that payroll number on a revised basis is showing positive job growth above 100,000, and we have other signs across the rest of the economy, and we don't have a chaotic financial event after Brexit, I'm almost certain they're going to raise in July. So it all depends on the data, but that July data is in play, and that's why it's 40, 50%, not 5.
So they're a little bit reticent with regard to our economy, is what's being read into this, leaving rates unchanged this last time around. What about our economy here? Is pessimism going to become the watchword going forward?
Well, they told us in the minutes a pretty good synopsis of what's going on. We got to say flight to safety, so interest rates are really low. Housing is doing very well. We see that household spending is doing very well. So households and household spending are doing very well. The other thing we saw is the net exports number are actually coming in better than people thought. And that's also related to the exchange rate, which is related to the interest rate. So those are the three areas: household spending, housing, and the net exports. It's doing better than people thought. What's doing worse is obviously the jobs numbers, which is the labor market, which is hiring by businesses. And the other thing businesses are putting off is they're putting off business fixed investment, which is machines, structures, things like that. So what we're seeing in front of the Brexit and with the lull in the economy is businesses are paying attention and they're holding off. But if you don't want to be too cynical, you realize they'll probably pull it off for a few months and they'll start to buy the second half of the year, and that'll take the GDP numbers up above 2% again.
All right, Japan also recently stood pat on their interest rates. That rattled the markets maybe a little bit, but you're not looking for a global economic slowdown, are you?
No, I am not, Terry. I think you have to bet with the ECB stimulus most of all. And, they have a 9.5% unemployment rate and a 1.6% GDP growth rate. What that tells me as an economist is they have absolutely no reason not to go the full direction they want, all the way into negative rates, all the way into massive QE, and keep it going all the way across 2017. So if you think these rates are low, I agree with you, but they can even go lower, and the ECB has no reason until they see 2.5%, 3% growth to get in front of this thing. So get used to it. We're going to have a rate-led stock rally after this thing's over, this Brexit thing, and that's my call.
So against that entire backdrop, just to clarify, you remain bullish on the U.S. stock market.
I do, Terry, and I'm going to give you 4 sectors that I have seen that are really doing well and some names that are coming out of them. First of all, consumer staples and consumer discretionary, 2 of the top 4 sectors. If you look at that household spending number, this is what they're talking about, the big cyclical areas and some of the basic everyday expenditures. A name I like is Church & Dwight. This is Arm & Hammer baking soda and all kinds of things around it. So Church & Dwight's a great dividend-paying stock in a consumer staple space. That's going to get a bid. The other name that I like in this space is in the consumer discretionary area. It's called Autoleave. Autoleave is basically your things that go along with car seats, airbags, seat belts, that kind of stuff for autos. So that's a very healthy market, and we're going to see another decent bid out of that whole area. So the third area I like is chemicals. And this is only chemicals that have to do with the consumer discretionary and consumer staples funding. But you get the plastics makers like BASF, which is a big German company. This is a very, very strong area. And the fourth area that I won't touch on with the stock pick is healthcare. The demographics are still remaining strong. Medical care is still doing well. And therein, those four sectors, there's no reason to bet that that's going to be anything but strong all summer long and into the fall.
But you're really focused on various areas affecting the consumer. And so does that mean that you are going to be paying special attention to inflation going forward?
Not yet, Terry. We still need to get some wage rates above 2.5% to see inflation. And, with oil kind of stagnating at $50 a barrel, that's not going to do it for us. So it's all about the wages. And we still have enough, part-time unemployment and people in the long-term labor force that are not joining yet or sitting around. So I'm afraid, we're not looking at inflation. The Fed's certainly said that. And I think that's the other reason they held off on rates is no inflation on the horizon, Terry.
All right. There you have it. Spoken word on the stock market, the economy, Fed funds rates, interest rates in general, all from our chief equity strategist, John Blank. With John, I'm Terry Ruffalo.